to give the same advice I used to give when I was dating. I would say, I just want one thing. I want your actions and your words to match. If your actions and words match, we'll be great. We'll do really, really well with one another. I've had a couple people call me and say, see, the housing market, it's not gonna crash. I'm like, we're not even close to that yet. There's one news story and people get all excited. I'm like, this is crazy. It takes a while for a market crash to happen. I know all of my C-noters know that. And I was busy. I must have missed a couple news articles of hope. There's not hope. I'm sorry. I don't mean to be the negative Nilly. Is that the right one? I mean, the negative person in the room. We're not even close. It hasn't started. What I always look for are actions and words that match. Right now, do not listen to the word, because all of the actions show something entirely different. And all of us could rattle off a million things that does not make sense. One thing I can say is our government has gotten smarter and learned a lot from the 2007, 8, 9, 10 financial crisis. They can hide it better. They're better at it. At least, they learned something. I mean, my hat's off to you for my respect for being able to hide it more. Just today I saw, and I'll show it here right up on the screen. There's a new article about there's the Fed discount windows where banks can go and borrow money overnight. The Fed had said we do not expect them to use the Fed discount window, and then 150 billion goes out. Now the beauty of it is they're blaming all of the discount window on First Republic and saying, oh, it was First Republic, now it's back to normal. Just stop. Just stop. Let's stop the talking. The Fed, this is awesome. The bank term funding programs, basically the Fed discounted their discount window. That would be an action, right? Let's not listen to their words. Not only do they have that discount window for banks for overnight, they have a different program as well called the BTFP program, which is the bank term funding program, which is set to expire in 2024. It's similar to the discount window. With the BTFP program, they take collateral from the banks, and typically it was at par or market value. If the bank collapsed, the Fed was okay because the bond or they put up, they could liquidate that and they would have their money back. But now what happens is if a bank puts up a treasury bond and has a value of $80, but it has a market value of $100 and the bank collapses, the Fed eats the $20 spread. Okay, well that makes sense. Yeah, that's a good job. Definitely do that. You could just print more money. I mean, why not? You could lose as much money as you want because you just print more money and kick the can down the road. I just don't want to be on the road at the end of the road when you can't kick it anymore. That's what I don't want. I don't know when that is, but I'm just hoping. I'm like, please kick the can, be able to kick that can. Oy vey. That is an action that does not match with, oh, life's great, everything's wonderful. The Fed's willing to take a hit for this BTFP and extend the parameters. That is one little hint that life is not okay in Oz. You have the 40-year AM that they have for when you default on your mortgage. They've loosened up lending requirements to get more homeowners so they can have more mortgage-backed securities because they've had interest rates so low for so long. The sellers are saying, hey, no, I want this house. Forget you. I'm not moving. I'm not moving at a 3% interest rate for a 6% interest rate. What are you, out of your mind? Again, let's look at actions and words. Home prices fell in a third of all U.S. markets in first quarter. Now that is a number that is also funny because they went up an astronomical amount and they need to come down. They still need to come down another 15 to 20%. I know the Fed agrees with me for sure. It will fall another 15 to 20% or the Fed didn't do their job. People can't afford the homes. The unaffordability index is off the charts. You can't have wages go up 4% and home prices go up 60. It's a math formula and it doesn't work. During the peak of the housing boom, home prices surged in every corner of the U.S. Now the housing market is split down the middle. The West Coast, the high-tech markets with all the massive layoffs, he got hit first and saw the markets decline. I still think it's a lot to do with the iBuyers and everything else that bought out there. There's a lot of factors that caused the West to to take the hit the first time. San Francisco posted a decline year to year. San Jose, Austin, Boise, Idaho, all the ones you've all heard before. But the home prices still need to go down severely. We're not close to the housing crash to be done yet. They have been bank runs. They're going to be more bank runs. And this is another key indicator, again, an action. Bonds backed by apartments are under stress as the housing market cools. There is a huge, massive commercial crash of epic proportions that is going to happen, in over $1 trillion in debt comes due in the next 2 years. Here's a list of the banks and how much office space lending that they have done in that time period. Some are on the hook. Wells Fargo, over $30 billion. US Bancorp is another one to look at. And also Truist has a lot of commercial lending on their portfolio. It's an issue. It's going to be catastrophic. It's not going away. And after the pandemic, people aren't going to office buildings. It makes sense to me. There's a product called CLOs, which are collateralized loan obligation. You have your mortgage-backed securities, which are MBSs. These are CLOs. They're usually used to back apart projects. As you buy bigger apartment, I had one non-recourse loan like this. I had a big apartment complex and I had a non-recourse loan, and it's from the life insurance companies. And they buy your paper and it has 40-year AM and it's non-recourse. That insurance company is pulling pensions. The money's coming from somewhere. This does matter to everyone here. Pensions could be wiped out. I'm not saying that they're going to be or whatever. I'm just saying it's a big deal. The commercial industry, the CRE is what they call it, the CRE industry, it's going to crash. They're worried about their CLO, the collateralized loan obligations. Rental apartments accounted for 2/3 of the CLOs issued in 2021. 81% of those issued in 2022 are rental apartments. Wow. The mortgage associated with CLOs appeal to property owners because they can put down less equity and take on more debt. Of course they can. Than with bank mortgages. They also have shorter terms and floating interest rates that make it easier for owners to sell or refinance the buildings after a few years. Due to the characteristics in the loan programs that they created, it made it riskier. Nearly $88 billion in securitized mortgages are at risk of default, and 42% of them are backed by apartment buildings. I'm starting to get PTSD. Woo. CLOs make up the majority of these at-risk apartment loans. We love debt, don't we? America, we're all about debt. If we're not spinning and packaging and bundling mortgages, we're packaging and bundling this. We are pretty ABSs, MBSs, CLOs, and you have the worst tranche in your, that's the other issue that there's a bunch of people that are in the third position, and that's not a pretty position to be in on that deal. The CLOs popped up all over the place because they were of interest to investors because they had a higher return. Well, no kidding. Higher risk, higher return, higher reward. When it goes bad, it goes really bad. The U.S. office vacancy rate in first quarter was 12.9%, which is higher than in 2008 during the crisis. There is going to be major challenges in the commercial industry and with the regional banks. Who loans the money to all of the office building? The regional banks lend the money. There's going to be many more bank runs or collapses. It's going to be difficult, and that's what I'm saying. The actions and words do not match. What I think the Fed is saying, okay, you're not giving me my unemployment number. Inflation's still high. I'm going to cause a credit crunch. Lenders are already starting to tighten up their lending criteria. If you've got to cut the money supply is what the Fed is thinking. If you cut the money supply, people will start laying off people. Action will start happening. We need the reset to happen because life can't be like this with the housing market and having these prices. I'd rather them just do it, get it over with, and let's move on. Fortunately, so does everyone else, and they don't think it's happening just because it hasn't happened yet. This stuff takes time, and every action has a reaction, and now the credit crunch it will cause things to move quicker. That's what I get worried about for everyone is that, get money, put it in a mattress, put it somewhere you can get to it. All of this happens, banks take back their credit line. If you do get a credit line, take the money out and save it and put it away. They might call it back. You want to be prepared going into this and make sure you have enough cash for you and your family. Once the credit crunch happens, and they've already started tightening their lending criteria. That is going to be what has stronghold around businesses, that they'll lay off, they won't be able to get credit, businesses will close, unemployment will go up, and the Fed will have finally what they want, foreclosures, homes. This is all just my opinion. Anyone on here, it's all but their opinion. Every action that the Fed and the government is showing us signals recession, housing market crash. I don't see anything that they're doing that signals anything else. I'm not just trying to look that the guy's bad. He's acting bad, okay? This is Dmoney. I absolutely adore you, and we will get through this together, and it's survive till 25. Peace out.